Hey, what's going on, everyone? This is Dr. Noel Liu, and we are here for another segment of our Facebook Live, which happens Thursday night at 6:30 p.m. Central Time. And today we have George again and our good buddy and partner, Tom Bibby Varghese. He is back here. So he came back from a long journey. I'm sure he's still a little bit jet lagged, but I'm sure he can hold it up tonight. So, ladies and gentlemen, so let's get started. Let's pass the mic on to Tom, and we'll kick it off from there.
Hey, good afternoon, everybody. So glad to be back after a short break. And I'm so excited and thrilled today, as usual, to join on the Facebook Live. We have Noel and George. George has been frequenting for our last few weeks and educating us. By the way, my name is Tom Bibby Varghese. If you have not met, I'm a entrepreneur as well as a real estate investor. Started investing about 4 years ago, and I've been able to grow my portfolio to about over 1,000 units, which includes multifamily, industrial, storage units, now short-term rental after partnering with George and other things. So excited, guys! Tonight's going to be a feast. We're going to talk about some very, very, very important things that you need to look for when you invest in real estate.
All right, George. Let's go with the
Hey,
quick
what's up,
intro.
guys? Yeah, absolutely. George Salas here. Glad to be here. Been hanging out with you guys for a couple months already, right?
Yeah.
So far it's been what to maybe since November. So we've done a couple deals, and just super glad to be here again. My name is George Salas. I'm a real estate investment strategist and short-term rental operator. We manage about $8 million in our own short-term rental assets within 65-mile radius of Houston, Texas. We manage a private equity fund. And then we love to bring value here. So I love joining you guys here every Thursday. So just super excited to be here. And I can't wait to talk about real estate. Let's do it.
All right. So let's start with the three things that we look for when we invest in real estate. So we're gonna kick it right off, dive right into it. So when we talk about real estate, what are some of the key aspects, some of the metrics that I've put down in some of my posts there? We always talked about cash flow. We talk about appreciation. Then we talk about depreciation. And then some of you guys are like, how can you have depreciation and appreciation? So, Tom, I want you to kind of chime in a little bit on those three things a little bit and kind of explain what appreciation and depreciation and how do they work, like on the same boat.
Yeah, great. Yeah, absolutely. So, the other thing also is, guys, a lot of people are wondering, why invest in why are we talking about investing in real estate or how this works? A lot of people ask the question, and a lot of people think that if you were to buy real estate, you got to own the whole thing, right? And I used to think the same way. I'm like, why should I partner with somebody? Why should I buy it with George and Noel when I can own it 100%, right? So that was like those the mentality that I had, and the scarcity mindset, I would say, is that I got to own everything. I got to own 100% of everything. I still own in this case too, but not 100%. So what I've realized is that once you partner, there's several benefits. First of all, I don't need to worry about managing the property. I don't need to worry about it. The toilets break, all that stuff. I don't need to worry about finding the property. There's so many things. I mean, the roles are distributed among the partners. And then I just enjoy the best part about real estate, which is actually what Noel was talking about, is appreciation,
Hmm.
cash flow, tax benefits, which is depreciation, right? So let's talk about cash flow. Any property that you go into, you should have cash flow day one, like not pro forma. Like pro forma is when somebody says, "I am projecting this property to cash flow in a year after we add this and add that and add that and all that." And you know what, guys, a lot of those may not pan out. So if his deck doesn't say cash flow day one, it's not a great thing to invest in, right? First of all, cash flow is why a lot of people invest in real estate. Like George's deals are like, man, that cash flow, I love the cash flow that comes in from the SDR deals, because nothing can beat the cash flow of that SDR deal. So cash flow. Second is appreciation. Real estate, it's not like stocks. I mean, there's a lot of certainty in real estate. All you have to do is invest, find a good property, invest, and simply wait. You don't, even if you don't do a lot of things, if you simply wait for like 5 years, that property will go up in value, appreciation. So those are the second thing why you want to invest. The third thing is depreciation, which a lot of people don't know. And I was surprised to find out that people who own assets in this group, like dental practices, you own your own office, and you're not taking depreciation on that, and you didn't even know about it, and you talked to your CPA about it, and they said no, no, there's no such thing. And even today, actually, somebody messaged me about depreciation, and the CPA said no, you can't take bonus depreciation. So, which is, guys, which is one of the major advantages of investing in real estate. Why does Noel get excited about real estate? Because he makes a bunch of money in his dental practices, and he doesn't want to pay the tax man, the IRS, all the tax, because I'm sure a lot of people, when you write that check to the IRS, that's one of the most stressful times, and causes a heart attack almost. So,
Every
but
time.
yeah, there
That
is a
hurts.
way around it. You don't have to do that. That's what's called as depreciation. So those are the three things, guys.
I love it.
So, George,
Yes, sir.
how important is, when we are discussing like what to look for. We talked about cash flow, we talked about depreciation, appreciation. Depreciation is a no-brainer. You get a cost seg done, we can get that depreciation a negative K1 on paper, right? But when we are talking about cash flow, we're talking about appreciation. How important is your sponsor or the person who's the quarterback running the show?
Mhm.
Yeah, 100%. That is a phenomenal question, Noel. So, being able to vet the operator and in going through a due diligence process with them, like getting to know them, understanding their best practices, understanding where they are really focused on, what their unique abilities are, and in seeing if that partner is a transparent operating partner. It's so important, right? So, when I first started real estate, I did not know how to do the proper due diligence on top of really just understanding the back end, right? And then I got into my first deal was the worst ever, but it got me to where I'm at today. So it was a great learning lesson. But understanding the actual operators' intentions, how they manage the day to day, and then just asking questions really. When you meet people, right, and especially in person, that trumps any Zoom,
Hmm.
right? So if you can meet them in person, right? It is so important to meet them in person because when you are face to face, you can't fake that, right? And you can
Right.
tell immediately if that person's being fake. So that's super important for me. What do you think, Tom?
No, I'm totally, man. That's, in fact, that is like a huge major, like the major two things, the deal and the sponsor of the deal. Man, I would not invest in a deal, even if the deal is the greatest in the world, if the guy doesn't know what he's talking about. I mean, I would not even go near that. From, I'm talking about from experience, which is one main reason why I like your SDRs, because you're an expert in that. So it's super huge, guys.
Let's dive a little bit into the different kinds of real estate we when we invest in. When we talk about real estate, we can actually mean a lot of things, right? So starting off with single family homes. Now it can be short-term rentals, it can be long-term rentals, it can be mid-term rentals, right? And then now we
Mhm.
got the multifamily sector where we can have multiple units under one roof. Then we have our mobile home parks, right? Then we have our flex industrial. Then we have storage units, land. I mean, we can go on and office spaces,
RV
strip
parks.
centers, RV parks, right? So in all of them, everything has one thing in common, like we just spoke about, is cash flow, depreciation, and appreciation. Now, if one person is an operator, and a lot of times, we have people who wants to be an operator and they want to control the entire deal. So, so Tom, like you were saying about two messages that you got today is these guys have their own practice, have their own building, and they have a few tenants in there, but they never were never told about, depreciation. They were never told about cost segregation. So how much time do you think as professionals, we seeing our patients on a day to day, how much time do you think, like, all this stuff takes to run this like a proper business? Because at the end of the day, when we are talking about investing passively into multiple deals, we are relying on those guys. But if you want to be a sole operator, you want to do the whole thing yourself, how much time commitment are we looking at in order to
Yeah,
get maximize every single bucket in this
yeah,
department?
that's a great question, actually. Which is another reason why I don't want to do deals myself. Is this is almost close to a full time job, guys. If you are going to run the show yourself, and if you want to run it efficiently, it'll take you a lot of time. I would say probably like 10 to 20 hours a week. I mean, there'll be you got to manage the property manager. You got to make sure the bills are paid. You got to make sure if the tenants move out, somebody's in there. I mean, there's so many, and then on top of that, you got to hire an accountant who knows what the heck they're doing to do the cost seg. Uh, there are
Right.
people who just do cost seg, so those are, I mean, it takes a considerable amount of time, guys, and this is for one property. Think about if you want to scale and you got like 3 or 4 properties. I mean, that quickly becomes a full-time job.
Yeah, absolutely.
Hmm.
What about you, George? When you are as an operator, I know with SDRs you have a lot of passive investors, right? What is one thing they're
Hmm.
looking for?
So, I mean, number one, I think that a passive investor looks for that advantage on being able to get a higher return than if they were putting that same amount of money in the stock market, right? So they are essentially, the first thing is cash flow, right? And what I want to explain real quick for those of you who don't understand what a cash on cash return is the number one metric for short-term rental investing. Now, there's other metrics that are super important for their asset classes, right? For short-term rentals, that's the number one. Right along next to it is the IRR, and we're only going to go a little dive into the cash on cash return, right? So cash on cash is basically, let me give you an example. It's the amount of cash you're getting back versus the amount of cash that you're putting in. So if you are
Mm,
putting in 100K, and in that year, cash on cash is measured yearly, right? You get $20,000. That is a 20% cash on cash. So that's, a passive investor loves the ability to get a higher cash on cash return in a short term rental investment, right? Typically, our deals, right? And I mean, there's different deals. Some deals have higher equity multiple on the back end because you're able to create more value, right? Our typical deals are going to be, some will have a big equity multiple, some won't because of how we're buying them, and some of them are going to be creative finance. But just to give a quick example, right? For example, we have some deals that we've acquired as short-term rentals that have cost us, 30, 40, 50K to get in, and then you
mhm.
put in a little bit of money into your 75 in, and then they're bringing in 30,000 a year in net cash flow. So I take the division, I do the math in there, and that's a good 30%. So some of our deals are 30%. If we have to put more money into the deal, like we're currently doing a deal in Cypress, Texas, right, and where Tom is a partner in, and we're putting a lot more money into this deal, but it is a triplex deal, multiple units in there. Now we're putting in more money as a team, so the cash on cash is going to be a little bit lower, but the appreciation in that one deal is going to be higher. So sometimes investors might look for one thing and they're really going to focus on, hey, I want to get a great return, but they might not see that there is a great appreciation play on this one particular deal, right? Or they might be a great depreciation play. And you're on top of that, you're going to be paying down the principal, right? What we call principal reduction, right? That's a fourth great benefit, because you're cutting it out, especially if you keep the properties long term, like 5 to 10 years. That is an advantage that goes unseen sometimes, right? So I think, I mean, in 2024, investors are going to be also looking for that upside, right? What do you guys think? I think 24 is a great year so far for us. So
It's a great year. Yeah, absolutely. You know, when we talk about real estate, right? It's a triple play, and you got to kind of keep in mind like everything, like you just mentioned. I love the point you just said that everything is like you look at it from a bigger picture point of view. So we got to understand like it's not only the cash on cash that's important. We also got to look at how much money are we saving on taxes and what is going to long term play with appreciation. So you touch base on that. That was really good. Tom, in multifamily, what other ways are we looking at appreciation? When we do the rehab, and what are we doing with the rents?
Yeah. So the other one is a forced depreciation, right? Well, when you forced depreciation is you go and buy a property, you renovate or rehab a portion of the property, maybe 50% of that, and then immediately you're able to increase the rents. And so basically, when a potential tenant comes in, they're going to be shown the new unit, and also you show them the old one, and they're like, "Hey, man, this is $1,500, but for $1,600 or 1650, you can get the brand new, almost brand new one with the granite countertop and all that." And guess what? They're gonna. If there's a
Hmm.
woman involved, she's probably like, "I like that granite countertop. Let's go with the 1650," and then the rent goes up, and as a result, the net operating income goes up, and because of that the value of the property goes up, and then you're able to sell it or exit the property or refinance it
Hmm.
at a higher valuation, which is actually what forced appreciation is. So that's another way to increase the appreciation of the property, right? No, what have you, no, you have done some of the deals that you've been part of, especially the San Antonio one, right? There's been some like the rehabbing going on and stuff like that, right?
Yeah, rehabbing going on in those apartments. Again, you got to kind of keep in mind, like, we cannot rehab it to a point where we are thinking, hey, it's something where I'm going to be living in, right? So you kind of have to
Yeah.
keep that in the back of your mind that it's not for us, but it's for the tenant or the target population that we are targeting. So we
Mm.
kind of have to go with that, and based on the rent value and based on the comps, like where these guys are. So that's one thing with the San Antonio deal. But I have a better example. When we talk about force appreciation, I'm talking about like getting into a single like tenant building or maybe even a small office building in a strip plaza, right?
Like a dental office.
Right. I mean, like the dental office is not there yet.
Mm.
And I say yet, right? So we got
Okay.
into that space. You can get these empty spaces like and in decent locations, by the way. You can really get them into like sub 500K, like 350, 400K. Now, if we can take that space and divide it into like, let's say, 3 or 4 spaces of, let's say, about 2,500 square feet each, and we
Mm-hmm.
have a total maximum of 10,000 square feet we can rent, and we just got it for 350. Now you see the play over here is get a broker.
Mm.
Let's try to get divvy up the bank to put some TI money for the tenants. Once we get a dental office in there, now we got a vet clinic like next to them. Now we got an optometrist next to them, right? And all these guys, the comp now, let's say the comp rents is about $22 a square feet. And now we can jack up that rent because we are offsetting the TI. And if they're getting a TI of, let's say, $50 or $60 or $75, on a higher end, they could even get up to $100, right?
Mm-hmm.
Let's say if we got them to $80 a square feet and we really jacked up that rent from $22, $23 to like $34. Can you imagine, Tom, and George, what is that doing to the NOI? Right.
Yeah.
I can't even
So that
count.
is a that's a great play because there are so many of these brokers that got into this business solely because of the real estate appreciation, and that is what I call a force appreciation. So if you got a building for 350K, and if you do the math right now, right? If we took that 34 bucks and you times that by, let's say, I don't know, 10,000 square feet,
10,000 square feet. Mm-hmm.
right?
Man, that's like 340.
Yeah, 340, and so, and all we got to do is take that money and we just times that divided by the cap rate. because most of these rents they're all triple nets, and it's like
Yeah.
pretty much you don't have any expenses coming out besides the the walls, the roof, and the floor, right?
Yeah.
So I've seen buildings where these guys they got it for 350, 300, and they turned around and sold it for 1.8, 2.2, 2.1,
Wow,
right? By
because
just having
they filled it up with tenants
quality
after the.
tenants, long
Mm.
term, 10-year leases, 11-year leases, and bam, that's it. Is it a lot of work? Absolutely. But it's quality people.
Hey, Noel, that's a really good nugget that you just passed out to people. I mean, I think you should repeat that just like in 2 minutes, like how, like if it's a dentist or a doctor, how they can go find a building and like just
Right.
and
So
you
so
want
the
to repeat
key
that? Yeah.
right, the key is these dental brokers who are actually selling practices, who are
Hmm.
actually listing those practices. They have these potential clients that they are looking for these practices. And what these guys are doing is they are actually getting empty spaces next to those practices for sale. But that's like kind of working against the seller, right? But these guys, sorry to say, but some of these brokers, I mean, they really don't care. They have to, do what they have to do. Because I witnessed it myself. This is firsthand witness, right? So you can take that new guy who is looking for a dental practice. It could be a gal too, okay? So it could be a gal girl. So that's what I mean. I mean, like you guys mean like everybody. So it could be a guy or a gal looking for a practice. They can easily go into an empty space. It could have been like an abandoned, strip plaza, abandoned store. It could have been like a copy center. It could have been, you name it, a restaurant, or it could have been anything that was before. And especially with these office buildings, a lot of people are emptying it out, so they're letting it go like on a fraction of a cost. Get proper tenants in there, get the NOI up, stabilize the property, get the bank to refi or go ahead and sell and make a fortune.
Great,
Love it.
great strategy, guys. I mean, it's a no brainer. If
Yeah,
you are already going to be the tenant, you should be doing this. There's no excuse. I mean, it's just a little bit more work. What Dr. Noah Liu just explained. I mean, it's a no brainer strategy to make $1 million just right off the bat.
right. And sooner and later in our episode, once when I'm done with my property, I will share a test. We'll do a case study
Mm,
on what we did, how we acquired it, what we did, and what we let it go for.
great,
So it's
that'd
gonna
be
be a little
awesome. Yeah,
while. Yeah, it's gonna be a little while, but it's in the works.
good.
What's the process for that? No, like how long does it take for you to turn around and do everything you just said and so, right?
I
Mm,
would say you got to give it a minimum of 2.5 to 3.5 years.
Because
okay,
you're
for the whole thing.
stabilizing the business too.
Correct, correct. The reason the 3.5 is a sweet spot is because if you got tenant A, tenant A, and you got an 11-year lease or a 10-year lease, they still have 7 years remaining, right? We got tenant B or tenant C, so you still have some time. So you want to be like in that ballpark. Everyone is at least 6 to 7 years remaining in the leases.
Is that for the buyer's comfort level?
Buyer's
Whoever's going to.
comfort, the
Mm,
value of the property, the value of everything.
good. That's
Because
great.
if you get someone who is at the last of their lease, now it's like kind of a little bit shaky,
Yeah.
Yeah.
right? Unless if somebody is like willing to stay another 5 years and they've signed it, they're ready to go.
What did you want to talk about how important location is when you do this?
Location, 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 right? We always keep talking about location. It's always, I mean, like any real estate we pick. So it's all dependent on the sector we're involved in. So with dental practices, with vets, with optometrists, you just got to go where the market is, where the people are. It may be a different demographics for people who are going to do flex industrial, right?
Yep.
Or for someone doing short-term rentals, like George can chime in a little bit on that. So everyone has their own demographics, but basically being in where the niche of that industry or the market is.
Yeah.
Yes, I totally agree. In the short term rental industry, I know we're switching off topics. It's
No,
location
absolutely, man.
is
We want to hear your perspective on short term rentals and how location plays a role too.
Absolutely. So when it comes to short-term rentals, location is very important, right? But sometimes you have the property itself driving the traffic, even if the location is not as good. So
Hmm.
you could be in a secluded area, right? With just having an awesome investment property that you turn into a short-term rental. And because of the amenities and the type of package that you've built inside this property, location becomes a secondary thing, right? So location is very important, but if you have a great property, then the property sometimes trumps the location. Now it's not a thing of like location is irrelevant. If you took the same property and put it in the middle of nowhere in but fuck Egypt or Clue, Texas or something, right? Then it's not going to work. It has to be within the means, right? So, but take the same project. We always must look on the real estate side, because when we do an underwriting for a short-term rental property, pro forma, right? We look at the real estate side, and that is always location, and then we also look at the short-term rental side, right? So just like when you do a dental practice, you're looking for real estate, and you know that real estate is going to appreciate, but you're also looking at it from a business
Right.
sense point of view. If this location will make a good dental practice, even if it will not make a good real estate piece of property. Now most of the time they're going to be both, right? A great location in real estate is going to make a great dental practice, right? But you don't know, right? So I would love to understand a little bit of the type of research that you do, know there.
With the dental practice, it's pretty simple, man. We a lot of these places have become really, really like AI dependent. When I say
Mm,
places, I mean like these guys who actually run demographics report. So one of the things that opened my eyes was number one, they're looking at all the regular stuff, right? Like median income, they're looking at jobs, they're looking at population growth, like foot traffic and all that stuff. Understandable. What really got to me was when they started looking at psychographics. And that is where it opened my eyes. And that is where these guys are actually targeting specifically the type of dental population who actually would spend money on dental or who've spent
Wow.
money on dental in the past.
Like, can
It's
you explain a little bit more about that? Psychographics? What is that? Like,
so psychographics is basically the psychology of a patient or any individual on
mm,
what they are spending on. So let's say John A and John B, they live in the same zip code, right? And John A, and they have the same median income. They have the same pretty much, work and, same kind of profession also. Let's put it this way. We can go as far as they got even the same similarities, right? But
mm,
John A is actually looking at spending money on, let's say, firearms, for example. He wants to spend money on trucks. He wants to spend money on, all these other stuff. While John B, with the same income, same kind of job, same profession, wants to spend money on his daughter's, orthodontic treatment,
mm,
right? So that's
mm,
where these guys are looking at. They go into specific spending habits by tapping into your credit bureaus. So Equifax is one of them. Experian is the other one. They will actually tap into those, get a score, and that score is used to generate lookalikes.
mm,
So they take a
mm,
lookalike and they be like, hey, you know what? You might want to hit these guys. So there's a high probability. Now, it's not 100% accurate, but there's a high probability that you will be able to get those lookalikes in a brand new location. So
wow.
that's where the psychographics come from. And that's where, when we are looking at real estate, we want to make sure that, hey, is the business aspect going to make sense? Because after all, it's a business that's going to drive the real estate value, right? So that's like
mm,
ultra important upon the sale of the business as well as for the real estate, if we're looking at a refi or sell.
mm. There's
So
Mm,
somebody asking on the comments if you were talking earlier when you were making an example of having to practice it and the practice and then flipping the entire business. He's asking if it's a property you occupy or have a practice elsewhere, and buying property as an investment. Did you see that?
So- Sorry, you were kind of breaking off for me a little bit.
Oh, no,
So
no, it's okay. I just saw
yeah,
a
yeah, yeah.
comment. Somebody was putting a comment in there.
Yeah, he's
I
saying,
think that's
are you
relevant.
talking about property you
You occupy
occupy
as
as
well.
well, or have a practice elsewhere and buying property as an investment? So
Both,
he's
both,
asking, are you talking about the property that you occupy as a dentist?
absolutely both. So let's say if I'm a dentist, now I could be in a dentist and I could be in a lease space. And I'm leasing the space. Most of our dental practices are leased. Okay, it's just one of them, or like that we own. But here's the thing: if you're leasing or you're owning, doesn't matter. So let's say if you're owning it, definitely you want to do something like that if there is room for growth, right? A lot of these guys I know, like a buddy Mehul, he has his practice. He's got, I think, 3 other tenants in his building, right?
Hmm.
And
Hmm.
he's renting it out. And his other tenants are synergistic businesses, like specialties, like pediatric specialists, or an endodontist. I think that's what he said, if I recall correctly. So you could have that as one, but let's say if you have that and you really want to venture out into something else, yeah, definitely go get a space and see if there's a buddy of yours. I would just start with the low hanging fruit. If there's a buddy or friend, or somebody in your relationship, family, or anything who's looking for a practice, and go ahead and build it out, right? And if that's kind of exhausted, then let's get a broker and let's try to put somebody in there. And a lot of times, these brokers, if we actually give them some sort of an equity in it, like a vested equity,
Hmm.
they will definitely find you somebody.
So when you say, that's an interesting thing you said, like vested equity, what do you mean by that? So,
So vested equity meaning, like, for every single person. So depending on the space we have, right? For every single tenant, they bring in a quality tenant. Like one dental guy comes in, a specialty, then a general dentist comes in, and maybe another specialty comes in. So for every single person, you can vest it out on their amount of percentages of equity they can get in that deal
okay.
upon sale.
Hmm.
So
Cool.
these guys really, really will make sure to do it. Or you can even go with another broker who can get you a chiropractor, or can get you a veterinarian, or they can get you somebody, like, from another field.
Yeah.
Like anybody, and nowadays those emergency clinics, they are hotcakes.
Mm. Emergency dental clinics,
No, no,
or
no, emergency medical, like, they
like the
have nurse,
urgent care, urgent
urgent
care. Yeah,
cares,
yeah,
right?
yeah. That's super hot.
Those are super hot. You can get your vaccine there, you can get your checkups done, you can get your emergencies done, and those are like super, super hot.
Yeah, man. We discussed a lot of stuff today. We went from
Things to look
three
for in real estate investing, to business, to all that stuff, right?
two.
Yeah.
That's awesome, though, man. There's a lot of value today in terms of, especially some nuggets that you dropped about how somebody can make $1 million real quick. If you just joined right now, guys, you got to go back and listen to what Noel said about how, if you already are renting a space, if you're a dentist, if you're already renting a space, and that is the 5 steps to how to create $1 million using your dental office. It's a no-brainer. You should be going and checking it out.
Yeah. So I think that was pretty good there. George, anything else before we land the plane tonight?
I think that's going to be it for me. Very, very interesting to listen to both of you guys talk about, asset classes that obviously not part of, right? And I like the fact that I'm learning from you guys, and appreciate you
But
dropping that
I
value.
want to ask you, George, the same question I asked you yesterday about this. There is a talk about, since the economy is, maybe you can take 1 minute and explain this, because the economy is, they're predicting a slowdown. Is that going to impact short-term rentals? We are almost out of time, so maybe take a minute and, like, say what you told me yesterday.
Yeah, absolutely, absolutely. So the way we look at markets and short-term rentals, it's not with what's happening in the industry only, right? So if you take a look at the actual data from last year, national data for short-term vacation rentals, right? There was actually a small drop in the in the revenue per available room. It's called the RevPAR. Last year was the first year that there was a drop in the industry. Has never been before. Now this year, the numbers are up. So things. I mean, last year was a year that was, there was a lot of uncertainty, right? That's a national, right? This year is not. So, but that doesn't affect me or us at all, right? Us as a group. Why does it not affect me that last year was a drop and this year is going to be higher or projected to have an 11 to 15% growth, right? And I'm just talking about RevPAR, right? Demand still grew, and there's other factors in the industry that grew. But the reason that it doesn't really affect us, it's because we like to find ourselves in a niche, right? So our niche is going to be that 4 to 5 bedroom. And so we're not competing for most of the national average, right? So we're not average, we're above average. So when we put ourselves in this niche, we're finding the top markets, right, to invest in. Within those top markets, we're finding the top properties. And what we're doing is we're basically coming in and saying, I'm going to build that castle. And my castle is going to be just as good at that castle. But guess what happens if you compare my castle to the little houses down the street, right? Well, we're separating ourselves from the competition because we're creating a product that's so good that people feel stupid to say no and pay that additional $400 a night. I'm just giving you an example. We don't build castles. I'm just giving this an example, right? Why do I say that? Because as a short-term rental operator, we have to separate ourselves from the competition. Most people out there just get started. They're not professional operators that just go out and launch a property, or they think they're going to make a bunch of money, and they that's all they do. That was me 5-6 years ago, launching properties that were just normal houses or normal apartments, and then putting cheap furniture in there. And I didn't know what I was doing. I didn't know what properties to price them at. I didn't know how to do the research, right? So now we create top 10% products. So every property, wherever we're in that market, we look at many, like actual details or many specs metrics to be able to make a decision. But we always put ourselves on top of the competition because we create the product to attract the demand, right? So now if I'm niche, just like real estate's local, right? In short-term rentals is localized, right? So you could create your own a little niche, and then it doesn't have to compare to the whole entire average of the rest of that market, sub-market, which could be your full city or small little city. It doesn't really compare. So my opinion is 2024, you just got to be a professional, right? So it's going to be great for those who are professionals, and it's going to suck for those who aren't. That's it.
Cool. Awesome.
All right, that was great, man. I think that's really going to help a lot of people in deciding about 2024. So, yeah, Tom, any last comments?
I think that's about it, guys. I mean, real estate is a long-term game. You got to be thinking about real estate as one of the asset classes that you should be investing in, and do not overlook that. I know stocks have been going up lately, but real estate is a sure bet. It's not get rich for quick, but it's get rich for sure. So think about that.
All right, everyone, let's land the plane here. Well, thanks for your time, George, Tom. It was always a great pleasure. And with that being said, we're going to be coming back again next week, Thursday night, 6:30 p.m. Central. So in the meantime, go ahead and watch this again when you have a chance. Any of you guys who missed it. For now, everyone have a good night.
Good night, everybody.